I'm Dr. Rachel Essig. I am the Resident and Associate Society Executive Committee Chair, and it's nice to welcome you all to this really amazing seminar today we have for your finances for the young physician. We have two great speakers who are going to be here and somebody who's going to be in the background helping to answer questions. So first up is Mr. Bill MacDonald. He is the founder and CEO of My Financial Coach, starting in 2018 after he had a lot of other successful business ventures. And they provide unbiased financial planning. And then we have Mr. Chris Pfanstiel, who is the founder of Access Wealth Advisors in 2019, and he is currently a wealth management advisor. And then we have a really wonderful person who's the Chief Operating Officer of My Financial Coach, Mr. Ampotu, who will be helping in the background answering questions on chat. So if you guys would like to start, we'd love to hear all of your wonderful things. Drop some questions in the chat and we'll answer.
Thank you. Well, good afternoon or good morning, depending on where you are in the country. Today, we're going to talk about personal finances for new physicians. But actually, there's a lot of content here that no matter where you are in your career, you're going to be able to use this. Or as you grow your career, there are many concepts we're going to talk about today. I'm Bill MacDonald, the CEO of My Financial Coach. I started My Financial Coach because I was really tired of getting advice from people that were selling me products and services. I had a great financial advisor. He was a tax lawyer, a CPA, a CFP, but I wasn't sure if he was working on his retirement plan or mine because he would always be pitching me a product. So we wanted to form My Financial Coach to be unbiased and unconflicted and provide advice only. So we're really excited about our partnership with ACS and the education we're going to bring today. So I'm going to start off by going through some concepts and ideas on how to get started, things to look for, mistakes that people have made in the past and maybe you can avoid. And then Chris is going to talk about student loans. He's a real expert in this area and one of our subject matter experts. Next slide. So from all of the work we've done, we work with over 400 physician families, and we've noticed a lot of common mistakes that have been made over the years by many of the docs that we work with. The first mistake is to equate high income with wealth. And the lesson from this mistake is it's not how much you earn, it's what you really take home from that amount. And we're going to talk about some of the mistakes that people have made. So don't confuse what you're earning, high income, with creating wealth. We also see that young physicians misjudge or overestimate the length of time in their career. What I often hear is people say, oh, I've got plenty of time to do that. And unfortunately, at My Financial Coach, we work with many physicians in their 60s and 70s who have not accumulated enough money to retire comfortably today. They're still working. They're still playing catch up. Many of them have chased shiny objects and listened to bad advice over the years, and they're in a position today. So my message in this one is to start early and get some education and start on the right track. Bad spending habits is another common mistake. Income has nothing to do with wealth building. It's not what you make, but it's what you keep. So we're going to talk about ways that you can start to accumulate in a tax-effective way. And growing the margin between what you make and what you spend, it's not only about increasing the margin, but it's really taking that margin and effectively investing it. So what we're talking about is you've got your earnings, you got your expenses, and the difference is that margin. So what are you going to do with that margin? How are you going to capitalize on that and build wealth? We're going to get into some of the details on that today. Next slide. So another fear that we see is the fear and perceived risk of investing leads doctors into two areas that we see. two critical mistakes that they make. They either feel that investing is too risky and they avoid it altogether, which is obviously a major mistake, or they feel investing is too complicated and they hire someone to do it. Now, hiring someone to do it is not a bad decision, but you got to hire the right people. So hiring the wrong people can be a major financial mistake. You need to understand the fees, the taxes, and the expenses and how people are paid. So advisors really come in different forms. Everyone says, I'm a certified financial planner. That doesn't mean much, except they are a fiduciary. All of my financial coaches are certified financial planners. But the major difference is you have a fee-only advisor. You ever hear the commercial on TV that we make money only when our clients make money? What that means is we're being paid on the assets that are accumulating. So you got to understand, how much are they being paid? How much advice are they giving you? So fee-only advisors or fee-based advisors are people who normally are earning dollars off of your accumulation of assets. You need to look at advice only. Advice only means I'm being paid for giving you the advice and I don't make any money on products or services. Like my own personal situation, my advisor, the conflict we always had, and I trusted many things that he did, but I didn't really know if it was for his benefit or my benefit. And you keep that away when you have advice only. At My Financial Coach, we're a subscription model. We're advice only. We charge a one-time setup fee and we charge a monthly retainer. At the end of this presentation, there are going to be two QR codes. If you're a resident or an associate, you have the opportunity to get a major discount for financial planning services. And if you're an experienced physician and surgeon, you have an opportunity to also get a discount and work with our services. Next slide. So the first thing you need to do as you start on this journey is protect yourself first. As a physician, especially at the beginning of your career, your future ability to practice medicine and earn money is great. That's your largest asset that you currently have. You're going to earn money because you don't have machineries and things like manufacturing companies. Your ability to earn money is your biggest asset. This involves protecting yourself and your future wealth from financial disaster. So you need to start by buying the right insurance coverage at the right cost. Now, if you're a young physician first starting out, you need to look at things like life insurance. And probably you want to start with term insurance. It's the least expensive. It provides the protection. Make sure it can be converted later. And you can start off early getting that policy and protecting your income from obviously death. Disability is one of the most important insurance products you should look at. Yeah, make sure you have the right definition of disability. The inability to perform the duties of your occupation, your specialty, your profession. But you need to make sure you continue to monitor this throughout your career, because as you change specialties or you change jobs, maybe becoming a chief medical officer, the definition of disability needs to track with what the policy is doing. You need to cover yourself for malpractice insurance. Now, if you're an employee with a major organization, they're going to provide that coverage. But if you're in private practice, you need to look for good malpractice insurance and maybe take advantage of some of the captive insurance arrangements that are out there to lower your cost. You obviously need to protect your home, your automobile, and get an umbrella policy to protect all liabilities. So start by protecting yourself first, and let's move on to the next slide. So learn to keep score. No matter how simple a game is, if you don't know or understand the rules, you're bound to lose. I'm an avid golfer, as an example, and I know the rules of golf. And if you ever watch the PGA on the weekend and you see top pros taking advantage of knowing the rules, They obviously score in the game. To build wealth, it doesn't matter how much you make, it's what you do with the money that you make. Now, if you have a physician that earns $200,000 a year and can save 20% of that, they're building more wealth than a physician earning $1 million a year and not saving anything. So you need to be on the right track. So if income is not the scorecard of wealth, what is? It's net worth. Net worth is your assets minus your liabilities. Let's go to the next slide and take a look at a balance sheet. So here's a typical balance sheet for you to start keeping score. So you've got your home equity, you've got your 401k, you've got an IRA, maybe rollover that you had. You've got an investment account, maybe a brokerage account. You have a savings account. You've got some real estate investing you're making. So you have total assets about $700,000. So when you take a look at the liabilities, especially if you're starting off today, you probably have student loan debt. You have a home mortgage. You have credit cards. You have a car loan. So your total liabilities here are $640,000. So your net worth is $60,000 today. And what we're going to talk about today is how do we grow the assets and how do we lower the liabilities so that we can grow our net worth, because net worth is really the name of the game here and how you keep score. So we talked about assets and liabilities. And as I mentioned, one of the biggest liabilities that you have today is that student loan debt. Now, a lot of financial advisors know a little bit about student loans, but we've got a real expert with us today. He's one of our subject matter experts. And Chris, why don't you take over and give us a little education on student loans?
Sure, I'd be happy to. Thanks, Bill. So everybody, the four initial approaches when you're an early career physician, let's say that you're in a residency or fellowship, are to start thinking about, will you ultimately seek some forbearance for the time being, or maybe you're put in one, and I'll describe that shortly, to refinance, to pursue PSLF, or to pursue long-term forgiveness. What I'm going to try to do today is help you understand both what those look like today and what those might look like here in a month or two. We'll see when legislation might pass, which ultimately affects loans. So we'll help you understand what the rules are today and then how they might change. Speaking about a forbearance for a minute, when I talk about forbearance first, I'm referring to the forbearances that you request. So if early career or during training, affordability is a challenge, I usually will tell physicians that affordability shouldn't be based on the way income-driven repayments are calculated. So usually when someone's requesting a forbearance, I'll remark that I think we need to explore income-driven repayment formulas a little further first and then deepen their understandings. However, if there's absolutely no way to make payments right now on federal student debt, then you can call and ask for a forbearance. A forbearance is the absence of a bill. And what that means is if there's no bill, you're not missing payments, you're not having any detriment to your credit or credit scoring, you're just simply not being billed. When you request forbearances, interest should still accumulate, and you should not be getting any credit towards PSLF or other long-term forgiveness plans. However, it's a way that you can, without an issue to your credit, it's a way that you can just not be billed for a little while. One of the best benefits of federal student loans is the fact that they can do this in almost an unlimited way. So you can continuously request forbearances if need be. Now, that having been said, an administrative forbearance is different. And a lot of folks, if you were one of the many, and it seems like everyone, but if you were one of the many who was in the SAVE plan, you've been moved to an administrative forbearance. The rules in an administrative forbearance are different. For example, in an administrative forbearance, if you were in the SAVE plan and put into this, you should still not have any interest accumulate. Now, we have noticed, and clients, much to their dismay, are still occasionally being charged interest, and that is a servicer issue. Some of the servicers have corrected it for clients. Others have said, we're simply too overwhelmed. And I'm actually not kidding. I know I'm being recorded. That's been the response. We're too overwhelmed right now to fix that. That said, if you were in a SAVE forbearance, or if you were in SAVE and went into administrative forbearance, you should not and are not responsible for the interest since that time. This would have started last July. Now, a refinance, if you're thinking during training that you want to refinance, I want to be very cautious. There's some very popular refinances through Panacea, through SoFi. There was the Laurel Roads for the longest time. When you do a refinance, some of the programs, especially if you're in residency or fellowship, let you pay, no matter how big the loan is, just $100. And if you're paying just $100 a month on a refinanced loan during training, that's terrific. But you need to read the loan agreement closely to see when those payments escalate. In some of those loan agreements, you start paying the full amortized large loan payments July post-training. In other ones, it's not until 6 months post-training. Imagine all the costs when you're interviewing, traveling, moving, first and last month rent. And by the way, you're probably not getting a paycheck in July. If your sign-on bonus isn't paid until you start, as opposed to maybe a promissory note when you sign or something like that, you could have pretty dry pockets, pretty empty pockets going into the first July post-training. So I always you're refinancing that $100 payment is nice, but we need to make sure the loan agreement has it starting 6 months post-training, not immediately post-training. It's very important. For folks that are already through training and they're still dealing with their student loans or deciding what to do, for those folks, we want to see refinance as an option, but I'm very cautious that you give up all federal benefits, including forgiveness pathways, if you refinance, and also it might be more difficult to get a forbearance if you refinance. Some of the private banks do offer those, though, so careful there. Another note on refinancing, and if you go into private practice and thinking you'll never do PSLF, we had a client, thank goodness it was during the pandemic, so the interest rate on his loans was zero. We had a client very excitedly, a surgeon signed at a private practice, and when he interviewed at the practice, he made sure that they'd never be hospital owned. He wanted to be in private practice. He was at the practice for about 3 months, and they sold to a hospital. And that's okay. In fact, it was terrific for his loans because now he's PSLF eligible. But I just want to point out, even if you think you might be private practice forever, if the interest rate for a refinanced student loan isn't significantly better than the federal, might not be that worth doing. Additionally, on refinance, if you have private loans, Sallie Mae, for example, can be very expensive. Those are almost always worth shopping and seeing if you can get a better rate, a fixed rate. Right now, we're seeing a lot of high 4s to low 6s for refinance loans if you have good credit. PSLF, of course, we understand is the ever popular public service loan forgiveness program, probably one of the most confusing loan routes. 120 payments with the appropriate loan type, well in the appropriate employment setup, would ultimately lead to public service loan forgiveness for your federal debt. Some of the nuances in PSLF I'll touch on in the next slide, but I want to be really clear that most of what I've observed in my experience, and we've had a lot of clients go through forgiveness, including through the buybacks available now. I want to be clear that my experience is most of the problems that people face tend to be user error. If there's servicer error, we can oftentimes find resolution. So I actually have more trust in the PSLF program than most people. However, if I'm talking to someone who's recently finished training and they're going through this program, I do approach it very cautiously. So while I trust it, I still proceed with caution. And what I mean by that is, should your budget allow, I ask a lot of clients to budget as if they have to make the whole payment, as if they're paying their loan off in a 10 or 15-year period. And then we'll do everything we can We'll file tax returns on extensions. We'll file separate tax returns. We'll do everything we can to create a lower income driven repayment that's actually due. And the difference between the amount that we budget and the payment that's due, we have them tuck away in what I'll call is kind of slang a loan backup account, which is just an investment account. And that money can accumulate while you're making smaller loan payments. So you're not counting on a program and for any reason finding out it's not going to work out for you. And years later, looking back and asking, why'd I ever do that? If the circumstances change, you could simply take the money in that account and make a large loan payment. And you've already secured room in your budget to keep paying the loan off in a reasonable time period. That's also helpful for financial planners. And Bo and his team, me and my team, we would say, boy, isn't it helpful if we know that your rising loan payment as you start reporting surgeon's income and in terrific numbers? Wouldn't it be nice if you've already budgeted for those payment increases, right? So you're not canceling subscriptions or talking to your financial planners about your budget all the time as you report higher wages a couple of years post-training. So important note there. Long-term forgiveness right now is in serious jeopardy. And there's not a lot of math that would say that long-term forgiveness is going to be usable for a private practice surgeon. It just doesn't check out when you calculate income-driven repayments. Some folks will suggest that PSLF doesn't check out with that math. But if someone's in IBR or pay-as-you-earn today, PSLF very typically checks out, because you should have several payments that were well below a 10-year payoff number if you were in IBR, PSL, or IBR or pay-as-you-earn here in the meantime. But in those payment plans, there's a ceiling where as long as you got into those payment plans before your income was too high, then your payment based on income never exceeds a 10-year payoff number. So in IBR, pay-as-you-earn, a high-paid specialist can actually get PSLF on a $50,000 student loan. So there's a large and common misnomer about the relationship between the income and the loan balance, where a lot of high-paid physicians will say they can't do PSLF. Those programs would really help change your thinking. If we look at the next slide, I just want to mention some payment formulas in pay-as-you-earn, in IBR, in SAVE, the payment plans you might be used to. The payment formulas start by looking at line 11 of your tax return, your AGI. They remove or they subtract a multiplier based on the number of people in your family applied to the poverty line to suggest you shouldn't have to make loan payments on all of your income, just on your income minus what it might take to cover bare essentials for a family your size. That then gives you a discretionary income number, and your loan payments are based on that. And there have been plans that look at 5, 10, and 15% of that number, but the payments were based on that. You'll notice the new payment plan works a little bit differently if it becomes the plan. The new payment plan says if you make under 10,000, or excuse me, 10 to 20,000, you pay 1% of your income. And that's divided by 12 monthly. 20 to 30, it's 2%, and so on for surgeons. 100 and over, you pay 10% of AGI. That 10% is not the discretionary income number that we're used to seeing payments based off. It's of all AGI. And because of that, we're expecting higher payments. You will, however, be able to subtract like $50 for each person in the household from family size. So there are proposals that even have you as you have children will shrink your payments, but not to the same degree that they used to. So I want to be clear, the new proposals do look like higher payments, and the big difference is how they're calculating the impact of family size. And then, like I said, I think 10% on everything is going to be where most physicians will land once they've signed their contract. We're hoping that we'll still be able to do some strategic planning around this plan. There used to be, like I said, very common practices. If you're going from fellowship to life as an attending, follow that next year and then the next year's tax returns on extension so you can get updated income verifications off your training compensation and stretch those low payments out a little longer. Some of those used to be nice. I want to also be clear, PSLF is tax-free. Up until the end of this year, forgiveness for something like disability also tax-free. After this year, we're expecting that loan forgiveness other than PSLF to become taxable income again. And if you do some of the loan strategies I talked about earlier, such as filing a separate tax return instead of a joint one with a spouse, it may have an uptick in your tax cost. So it's very important to talk to professionals about whether it saves you more on loans or than it costs you in tax. Typically, I'm seeing it work that way where it saves you more on loans than costs you in tax, but it is important to review. Also, Bill or MPO will want me to mention if you file separate tax returns, you have to do backdoor Roth instead of normal Roth IRA funding. So if you're in training, that would be another consideration. I mentioned the loan backup account on the previous slide already, but I also want to talk about general considerations for IDR selections for a minute. When you're looking at these income-driven repayment plans, so IDR is the acronym for all plans. IBR, ICR, pay as you earn, advice, pay as you earn, save, and this new RAP are all types of income-driven plans. So IDR is the general label. When you're looking at those, they either could look advantageous because they have the lowest monthly payment, because they have an interest subsidy, which the new one might very well have, or because they can help you qualify for PSL or something like that. So there's different advantages between one and another. I would encourage you to make sure you understand the differences between these before you pick one just based on payment amount. Some frequently would include, I apologize, Empo, can you go to the next slide? Is this true out of 1099 or independent contractor agreement that I can't refinance my loans? Is a common one. If I have PS, so I'll cover that. Usually the loan refinance companies want to see a couple years of earnings history. So it might happen that your first year, second year post-training, it's hard to refinance, but it is still possible. You just might have to be patient. I covered earlier if I have a small loan balance relative to income, is PSLF still an option or is it a moot point? And so we did cover that. I'll skip that one. If I have additional loan forgiveness from something like HSRA or VA or another place, how do I navigate both forgiveness processes? It's very important, and we can help you to spreadsheet it, but it's very important to understand if these other loan forgivenesses generate taxable income to you, like the STAR program could for addiction medicine, could, that is going to drive off year's ideas. However, our experience is it's almost always the case, other than one military program, it's almost always the case that the extra forgiveness only helps PSLF. Why do applications get denied? How can I safely or accurately approach forgiveness? I would encourage you to work with professionals. I would encourage you to submit your employment verifications each and every year. In addition, if there's a change in employment, I would submit another one then too. And that gives you a chance to catch anything that's going wrong along the way. And then I would also encourage you to download your student loan data by going to studentaid.gov, hovering over your name, hovering over where it says My Aid, clicking the mouse there. The page will refresh, and then hit download My Aid data. By keeping a very accurate record of your student loan history and student loan data, you can audit and review everything that's been going on and try to catch problems along the way. And then, like I said before, how do I manage tax returns? I genuinely believe working with a tax professional and or a CFP or a student loan expert is going to be very important. So each year you understand which way to file taxes is best for you. So I
That's,
got a note that I was lagging. I apologize, but Bill, back to you.
yeah, yeah. Yeah. So again, the chat box, you can get some additional information or ask additional questions. So there's no easy fix for putting more spendable cash in your pocket. So we talked about growing your assets, minimizing your liabilities. So taking out additional patients to earn more wages or 1099 work could actually make things worse from a tax perspective. Next slide. So for most medical professionals, it's implementing a financial and tax planning strategy that can lower your taxable income, reduce your overall tax rate, utilize available tax deductions and credits, many we see CPAs overlooking, and to maximize your retirement savings opportunity. Next slide. So most CPAs and tax planners are looking in the rearview mirror rather than through the windshield. I even have personal experience where at the end of the year, I'm working with my CPA to do certain things, and all they want to do is file my tax return. They don't really get proactive in looking for ways that you can minimize your tax. And if you're a younger physician, as Chris talked about, it's very important to lower your income, especially in those early years. But even if you're an experienced physician, growing the difference in that margin, growing in your benefit rather than the government's is really important. So you need to make smart year-round decisions as you do your financial planning, not just wait till the end of the year. And doing proper planning can significantly reduce your tax liability and ultimately put more money in your pocket to put towards programs that are going to benefit you, especially in the future. Next slide. So let's take the first step. So how do you create wealth from money you already make? So the first step is to figure out what your monthly expenses are. So at My Financial Coach and working with our clients, the first thing we want to do is figure out how much money is coming in and how much is going out and where's it going. So we need to set up a good budget. And then pay yourself first by taking advantage of your employer's retirement benefits. A 401k, or if you work for a nonprofit organization, it's a 403b or a 457. If you take a quick look at this slide below, you can see on the left-hand side, if you basically paid your taxes and invested at a 6 or 8% return and paying taxes on the accumulation, you can see what you can accumulate. But look at the difference if you can put it into a tax-deferred arrangement. If you can put it into that 401k or 403b or other types of deferred arrangements, growing the money tax-deferred creates a lot of wealth. So you need to start by maximizing your benefits. I remember when my daughter took her first position at a company, she said, "Should I put money in the 401k plan?" And my question was, do they match it? And she said, yes, they match 50 cents on the dollar up to first 6%. I said, think about that. If you stay during the vesting period, which she told me was only 3 years, that's a 50% return on your money, because they're making a contribution towards your retirement plan. So you should at least put money in to take advantage of up to the company match. Next slide. So we're going to have a little fun here with a journey, navigating and understanding tax implications. So let's talk about how people save for retirement. So how do people save for retirement? So I'm going to use an example here of a person growing in income, age 45, could be age 25, 35, and I'm going to call him Henry. Henry stands for high earner, not rich yet. We're going to make Henry rich during this whole presentation today. So he's starting out. The first thing, as I indicated in the previous slide, that you want to do is take advantage of that tax deferred bucket. So you can defer income in a 401k up to $23,500. And again, if you're getting your employer a match, that tax deferred bucket is growing. If you're over age 50, you can put up to 31,000. And if you're between the ages of 60 to 63, a new provision in the tax code, you can actually catch up and put up to 34,750 into a program. Now, if you work for a nonprofit organization, you can put money into the 403B, which is the same limit as the 401k, and you can put money into a 457B if they have it, doubling up. But you have to be very careful on that 457B because eventually it's going to be paid out in most cases in a lump sum. So you're really kicking the can down the road from a tax standpoint. And that money is subject to the creditors of the institution that you work for. Now, if you're fortunate enough to have your own practice, you can go to the left side here and do a solo 401k and put up to $70,000 away. And again, if you're over 50, 77,000, and you can take advantage of the 60 to 63 catch up. So you can accumulate a lot of money in this tax deferred bucket. Next slide. Now, once you start to grow a practice, if you're into private practice, eventually you can do something called a cash balance pension plan. And here it's, large amounts of money can be deferred, up to 480,000, and in a lot of cases it can go into this bucket. So the first thing you want to think about is, how do I minimize my taxes? How do I save money that otherwise would have gone to the government to grow these tax deferred buckets? Now, in our planning with our clients, we're going to talk about Roth plans and when you should use a Roth instead of a pre-tax, when you accumulate in a pre-tax and when you should do Roth conversions and so forth. A lot of that is based on individual circumstances. And in the planning process, we want to ultimately get, as you'll see, to money that's coming out non-taxable in the future. But let's start off young in your career and start taking advantage of some of the programs that are out there. Next slide. But before Henry, in this case, can do anything else, there's a major intervention here called the IRS. The IRS is going to play a very important part. Next slide. Now, Chris Rock, before he was slapped by Will Smith, came out with a quote that was pretty accurate. He said, you don't pay taxes, they take taxes. So they take taxes from you, and as you can see from this photo, it's theirs, right? The IRS. So what you need to do is figure out, how do we minimize taxes? But once you fill up those tax deferred buckets in the beginning, everything we're going to do from this point forward is going to be with after-tax dollars. But we need to maximize that and not spend additional dollars on taxes. Next slide. So as Henry goes through his journey, now he's going to set up a brokerage account. So as you notice, this bucket's a lot bigger. It's a lot bigger than the tax deferred bucket. So there's lots of investment options. You got real estate, you got stocks and bonds and all kinds of different private equity funds and everything go into this big bucket. And there's no government limit on the amount you can fill this bucket up with because you're putting after-tax dollars. So these are brokerage accounts. However, you'll notice that little aggravating spigot coming out the bottom down there called taxes. So anytime you're pulling money out of this, you've got capital gains tax that you're going to have to pay on everything you've accumulated. Even though you put after-tax money in, everything you're accumulating is going to be taxed at either capital gains or ordinary income. And also, if you're into things like mutual funds, so you buy a mutual fund, it diversifies you, you grow that money tax deferred. However, the IRS has what they call realized gains. So even though you're not selling the mutual fund, something's happening where the mutual fund company is actually selling shares inside, and therefore you get a tax bill coming out that spigot each year on what we call realized gains. Next slide. So in Henry's journey, someone comes along and says, hey, you ought to look into an annuity. So annuity is a good tax deferred vehicle. What you're doing here, you're putting after tax dollars into the annuity. It's growing tax deferred and you take it out in the future. But you should be very careful with annuities because there's lots of benefit options you can buy in the annuities. There's load structures, there's different types of annuities. So you should get education on the annuity, whether you should do it or not from the person selling it to you, but from outside advice. And probably for the young physician, it might be a little too early to be thinking about an annuity. You've got other options that you can be saving your money before you get to the annuity. But again, in Henry's journey, it was one of his options. Next slide. So now we get to the point where you're ultimately going to be taking distribution from this. So we have a line down below here called the accumulation phase above the line and the distribution phase under the line. And this is when you're going to be in a position to start taking money. So it doesn't matter what you're worth above the line. What really matters is how much you get below the line. So many of our clients, back to that balance sheet we went through, said, what's my net worth? I have $1 million that I've grown in my IRA plan. What's my net worth? Well, we'll give them credit for $1 million of assets. But remember, ultimately, they have to pay taxes when they take distribution on the IRA. So that IRA is worth a lot less below the line. So you got to make sure that you're understanding, again, the accumulation. You're kicking the can down the road with most of this, and you're going to pay taxes in the future. Next slide. So in our example, we talked about taxes. What kind of taxes are there? There's federal taxes, there's state taxes, depending on where you live. You got Social Security tax that's being taken out up to $176,100. Then you got a Medicare tax of 1.45. And then we got that SALT tax, the state and local tax. The thing they're fighting about in Washington today has now been capped at $10,000. So if you've got a property tax bill of $20,000, today you can only deduct $10,000 of that. So again, you're being pulled by additional taxes. And one of the strategies that we work with at My Financial Coach is how can we minimize these taxes so that you can accumulate money in a tax deferred or a tax advantaged way for ultimately taking these dollars in retirement. Next slide. So let's talk about state income taxes. So how high are individual taxes in your state? So you can see California as an example. If you work in California, the highest marginal tax rate is 13.3. But you see the gray states there? There's no income tax in those states like Texas, Nevada, Florida, etc. So many of our clients have accumulated money in those tax deferred buckets and high income tax states, and they've moved to lower income tax states. And there's a provision within the tax code that allows you, if you establish residency and you take these out of plans that qualify for this tax provision, you can pay income taxes only in the state you reside. So we work with many clients that are in New York that decide to retire in Florida, and they save all of that state income tax. So in my California example, I moved personally over to Arizona and started taking distribution. So I went from a 13.3% deferral of income in California to a distribution takeout at only 4.5. And I think we're coming up with a flat tax in the next couple of years in Arizona. But where you retire is going to be important too. And as you go through this financial planning journey, you've got to think about these things in the future. Next slide. So on top of that, we talked about state and local tax. Property tax is a big thing. And this slide here basically shows you that number one is the lowest state of property tax, and 50 is the highest. Connecticut has the highest property taxes in the country, and New Mexico has the lowest. So as you think about your taxes paying income, going back to California example, you can see here that they're 14th in property tax and they're very high on 13.3 in income tax. Down in Texas, there's no income tax, but you can see that they're 36th in on this list of property tax. Now, my son lives in Texas, and he has a home of about $600,000 a year, and he's paying $18,000 a year in property tax, paying no income tax, but he's paying high property tax. Now, if he had that same home in California, if you could ever find a $600,000 home in California, he would pay a lot more, about 40% less in taxes. So you need to look at all taxes in all aspects. That's one of the things we do in the planning process is to look at everything. Next slide. So let's go back to that taxable bucket. There's one other thing that comes out of this bucket. So the Affordable Cares Act came out with a tax on accumulation in that taxable bucket. So if you hit certain limits, you've got that investment income that's growing inside that taxable bucket. There's an additional tax of 3.8%. But if you put the money into those tax deferred buckets, there's no ACA 3.8% tax. Again, it's asset location. Where are you putting your money and how is it being taxed? You've got to understand all of those elements. Next slide. Okay, so now Henry's been through this whole structure, and now he's turned 55. His advisor said, you know, Henry, you've done quite well in life. You've put a lot of money away in these tax deferred buckets. You've got a nice taxable account. You might think about kicking back. But no one told him about some of the big surprises that he could run into. No one told him about this 59.5 ruling the IRS has. See, if you withdraw money from those tax deferred buckets before the age of 59.5, the IRS slaps you with 10% penalty. So if Henry really wanted to retire at 55, he should have thought about asset location a little differently and not accumulated so much money in those buckets. So when Henry and his wife hit the ripe old age of 62, they now qualify for Social Security. And much to their surprise, they found out that they're paying 85% of the Social Security is being subject to taxes because of the withdrawals they're taking from their retirement. Now, under the tax bill currently, they're talking about eliminating that, but today it's in place. And then when they hit the ripe old age of 65, they qualify for Medicare. Now look up here, we have this term AGI, and Chris talked about this earlier, your adjusted gross income. So everything in Medicare and Social Security, taxation and payments are going to center around AGI. So the object is to try to get as low of an AGI when you get into retirement as possible. And then a required minimum distributions is something that the IRS is coming back with, saying, look, you've accumulated this money over the years, and it's about time you start paying taxes. So when you hit age 73, soon to be 75, they want to get paid. So they're going to require you to take distribution, even though you don't want to take distribution, so they can collect their taxes. Let's go to the next slide. So when Henry and his spouse reach the ripe old age of 65, they qualify for Medicare. On the next slide, they go to the Medicare.gov website, and they're going to take a look at this chart. Empo, next slide. See, depending on what your adjusted gross income is, you're going to pay more in Medicare costs. So the higher your income, the more they're going to withhold on Medicare. So again, if I keep my AGI down, I'm paying less in Medicare cost. And again, you have to take a look at that. Next slide. So now Henry's leaned back on the couch and saying, okay, so what should I have done differently if I had proper planning early on in my career? knowing that I wanted to retire early, knowing I wanted to maximize money below the line, what should I have thought about? You should have thought about tax advantaged opportunities. So if you look on the right-hand side, you'll notice that the tax advantage drops below the line. And if you want to write something down, write the words non-reportable income. So everything that comes out of this bucket drops to the bottom line and is income tax free. So first thing you think about is a health savings account. And you say, why am I thinking about a health savings account? Isn't that to offset medical expenses? Yes, it's going to do that as you accumulate money. But if you maximize your health savings account, you're putting more money away, tax deductible, growing tax deferred. You use it for medical expenses not covered. You're required to have a high deductible medical plan, so it fits for most people, not all people. And then when you get into retirement, you can use your health savings account to pay your Part D of Medicare and your prescription drugs and also Part B. So you can pull money out to do that, and then you can actually turn it into what looks like an IRA distribution and be taxable, but you've accumulated this money in a tax-deferred vehicle that is tax advantaged. As we talked about earlier, you might have done some Roth conversions along the line. Early on, when you weren't making a lot of money and you weren't paying a lot of taxes, you might have considered that 401k or the 403b is to put it into a Roth type of structure. Or you might think about somewhere along the line converting some of that money into this tax advantage Roth, because it's going to be after tax dollars are going in, it's going to grow tax deferred and pay out tax free. And then finally, there's a number of insurance contracts out there that look like a Roth. They're designed to be cash accumulation type vehicles. Now, don't confuse this with whole life insurance or term insurance. It's not really designed that way. It's got high cash values, it's got lots of investment options, and it's used to grow money tax deferred and pay out tax free. Next slide. And for those that have practices and put in that cash balance plan, there are ways of converting the assets in the cash balance plan to tax advantaged assets to drop below the line. Next slide. So we talked about a lot today, and we're going to have a series of a number of these webinars in the future, and we're going to talk about advanced strategies and so forth. But for this, think about diversifying your tax strategy, thinking about asset location versus just asset allocation. You need to manage your income and taxation in retirement because of managing your longevity risk, and again, taking advantage of some of the programs that are available today. Next slide. So we'll open it up to questions, but take a look at these two QR codes. Now, for residents and associates fellows at the bottom, you can click on that or take that QR code and you'll see a special offering, major discount to get financial planning help. And if you're an established physician, the same, working with ACS, we've established two great programs to help you get on the journey. And again, all of our CFPs are salaried employees, they're fiduciaries, and they're not selling products and services. We're advice-only strategy. So with that, let's open it up to questions.
I think all of our questions in the chat have been answered. I had a question for the trainees who are still in a training program and maybe surgeons who have just kind of graduated from a training program. What's the stepwise approach you would take to getting all of those insurances that you talked about? Like, would you get your disability insurance during training? When should you kind of think about life insurance? What are maybe a quick timeline that would fit?
Yeah, great question. Chris, do you want to talk about the disability side of that? When they're young, when should they consider putting together their first disability policy? Obviously, the younger they are, but what are some of the advantages of doing that?
Yeah, so I like to tell folks get disability before you're out of your program. You could sometimes still get the same terms and arrangements from the big carriers shortly after finishing, but that's usually with a bit of an exception. While you're still in your program, most carriers offer discounts. They also offer easier pathways to get policies issued, and they also forego most financial underwriting. So you can get a policy or a couple policies, depending on specialty and where your next contract might be signed. You can get one or two set up. And oftentimes you're going to go to a Mass Mutual principal and emeritus or guardian or what have you. But when you do that, you want to look at a policy that might be for what they call their beginning professional limit. Historically, that's been about 5,000, 6 in some specialties. Mass Mutual did just raise that limit to 7,500 as an example. So you can reserve up to that amount of tax-free coverage with an option, almost like a derivative, to add more coverage. And again, they're not going to do the financial underwriting, and they will go a little easy on getting the policy issued if you're still in training. And probably the most important thing is you're going to get a discount. Usually it's 20 or so percent, depending on your hospital. So I say get that during training. And to add to that, the other one that I think is really easy to get done during training, because you could wreck a car anytime, is when Bill talked about the home, auto, and umbrella. That umbrella policy is like your malpractice for the rest of your life, for when you're driving a car, for when the Amazon delivery person could trip on a sidewalk, whatever it might be. I like, because an umbrella policy is so cheap. I like to have folks talk to their agent, their whoever does their home or with their renters and their auto. I like to have them talk about that during training as well. Again, the problem could happen anytime, and that's a cheap fix. So disability and umbrella are probably the two easiest, quickest during training. Some carriers, if you're doing DI, will give you a bit of a discount to get your term life at the same time, and some don't. And sometimes you'd get them from different carriers anyway. But if you're starting a family, the term life insurance becomes an essential during training as well. For someone single, no kids, and about to do locums and enjoy some tropical climates, that person might wait on life insurance as an example.
Thank you. Additionally, you were talking about, trainees with children, and I think it's a lot of times people defer having a family. However, if you do have a family and money is even tighter than, just a typical trainee, what's maybe something that you can do to help build wealth with like $25 to $100 a month?
Well, Bill gave the perfect example. You might even be doubling it if you put it in your employer-sponsored plan and they have a match, right? So generally speaking, that profile of a person would look to put money in their 401k or 403b through the program, and they would elect to put it in the Roth side of the plan and capture whatever freebies in the way of employer matching they could get. If that person is not sitting on sufficient emergency fund or what if, type money, it's okay to be patient and not get that 25 or 50 to count aggressively for the future just yet. And I say that mostly because the amount of stress they could be dealing with between work and then counting every penny that's going out the door as they raise kids during training, it might not be worth that extra $50 match. But if they're really focused on the future, get that employer match as first and foremost, and then anything above that, Roth IRA is where my thinking would be.
Thank you. And then one last question. A lot of trainees also don't have money for a tax professional during training. However, do you feel like it is worth the investment to have one during training, or at least have somebody, more than the online version that you can do easily?
That's an interesting one. I think in the first year post-training, you're going to really feel like you had one, right? That for that year, July through December, when you start your jobs, um, and you want to get their advice before next February, right? So in my experience, a tax professional really earns their keep during the year, not after the year when they're putting numbers in boxes and the numbers are already determined and locked into cement, right? You can't, there's no time machine that your CPA gives you in March. So if you're going to engage one and make sure that they'll help you with projections during the year and learn from the numbers before they're in their final, positions when you can still make changes to that story. So I would say engaging one as soon as you're done with training and getting a projection and setting a good tax foundation before the year's over, and they work on your first return post training. It's like a half year. That would be sort of my latest answer, and by all means, if it's comfortable getting help along the way, please do it. Sometimes the traps you find yourselves in are more expensive than the fees they charge, but I respect and understand that returns can be very simple during training and money can be tight.
I have a separate answer for that.
Sure.
If and unless your CPA is itemizing for you, you can use TurboTax and file the standard deduction yourself. Don't waste your money. So you have to think about it though. Am I really going to save that much more above and beyond my standard deduction using a CPA though? You have to think about that because right now you're single, it's at, let's say 15,000. So let's say, you buy and gotta think, right? Buy a very expensive house. You're able to write off the interest expense on it. Let's say that you're able to write off $17,000. You go, wow, that's great. I just saved, $17,000 on taxes. Well, let's think about that. Peel that onion back a little bit. You're saving, 2,000 that you're deducting at whatever your top marginal tax bracket is. Let's say you pay quite a bit in taxes. You're at 37%. Well, that's 37 cents back on $2,000. So you're all here with pretty good math and science skills, so I'm pretty sure you can do the math. That doesn't really come up to a lot of pennies for potentially a lot of effort. So I would say this, unless you can mathematically figure out that the money that you're paying a CPA is going to save you enough in taxes, I wouldn't do it. Personal. I'm just saying. Ultimately, good CPAs pay for themselves, all that good stuff, but I would say look at the scorecard. If your CPA is having you file for a standard deduction 2 or 3 years in a row, you can do that yourself. It's costing you a lot of time and effort to save receipts and all that stuff.
Thank you all for your time. This has been really beneficial. Everyone that is watching the webinar, please use the QR codes. It is an amazing discount for the trainees and the associate fellows for using My Financial Coach. And Brad dropped into the chat that you can actually meet them at Clinical Congress in October 2025. So please come and meet them. They've said a lot of things today that I did not know as a financially illiterate resident. So I appreciate all of your guys' perspectives and help. And I hope that everyone signs up for the services.